It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. The yen tumbling past another psychological milestone for the first time since 1990, raising new questions about a lack of intervention. Asian stocks building on their best week of the year ahead of a deluge of corporate earnings and a Fed decision. Chinese equities heading for a bull market. And Elon Musk making a surprise trip to China on a mission to reverse Tesla's revenue decline. Let's get to David Inglis on the big moves in the Hang Seng Index poised for a bull market. Dave, talk about a reversal of fortune.
It's quite something. In fact, you know, what seems different, and I have to take a step back and look at it over a few days, right? So last week, and we covered it extensively, of course, it was only Hong Kong that was actually waking up to a large extent. Some of the big price moves, some of the volumes coming through, some of the flows really coming into Hong Kong across the Stock Connect. In case some of our viewers missed that statistic, right? Every single day from the start, from when these Chinese markets came out of the spring holiday early in February, there was only one single day where we had outflows to the Stock Connect. So that's one part of the story. Hong Kong has done well. The best week in 12 years yesterday. What's different about today is you're getting onshore markets starting to come alive as well. The CSI 300, 30 minutes to the break, is at 1.3, 1.4%. And you're also getting pockets of this market that weren't participating in the rally last week. I'll mention two. You have casinos doing very well. You have some regulatory news coming through there as well. Easier entry and exit procedures going into Macau. That was announced on Sunday. That's number one. Number two is, and we're trying to also get to the bottom of this, this big move up in arguably the weakest sector market-wise out there. Eco-wise, it's also quite a weak pillar or lack of pillar of growth, which is property. That gauge is up 10%. We don't normally see that gauge move up this much. Yes, as a percentage of it being able to move the market, it's not as big because these are small caps. They've come a long way down that market cap spectrum. On the weekend, you had Chengdu coming out and relaxing some of the measures, apart from other things being discussed in this market, which we're trying to figure out as well. In other words, the stars are aligning for this to come together. And I should note as well, this is taking place against a backdrop of a slightly stronger dollar as we speak. That's probably down to what's happening with the Japanese yen, for example. That's a different conversation altogether. But yeah, we're getting a lot of momentum come through. And it's hard to get in the way of this market on the way up. Most indicators do suggest that there's really some strong upside over the short term. I'll leave you with this. Nomura, we were speaking with him earlier on, Gareth Nicholson, about 2 hours back. We're at 59 on MSCI China. It's still tactical. It's a tactical trade for them still. He thinks we get a 64 on this specific index has.
But Dave, really bearing in mind as well, this is a market that's been very headline-driven. Jitters in the market enough to perhaps see a reversal in just a matter of one headline.
It could. I mean, I think what you're underscoring there is policy, the policy risk, or at least the risk that, you know, one piece of news negates everything else we've seen. All that being said, of course, that underscores the weakness macro-wise. So far, a lot of the people we talk to consider this still a tactical trade. The hedge funds are coming in. It's the easiest one to reverse. You know, what's really made money for a lot of these macro funds was certainly long U.S., maybe long Japan, short China. What happened last week on price makes you rethink if you outperformed or delivered alpha because you were underweight China, you might need to rethink that this week in order to preserve, of course, that outperformance. Now that we've broken through key moving averages, your 200-day, for example, on the Hang Seng China, MSCI China, pick your benchmark. We've taken that out. It's yet to be seen, of course, if earnings are able to deliver that fundamental story, because the data from, and I'll bring in another report coming out of Bloomberg Intelligence on the weekend, they release it on Sunday. Earnings growth, that's still a U.S. story, 17%. We have a Bloomberg Global Bellwether Index, 128 stocks, Bloomberg Intelligence. They've crunched the data. Companies that have reported earnings so far and expected earnings, they put all the data together. It's still easily a U.S. market story. That being said, flows are really coming in to this Chinese market this Monday morning, has.
Stunning to see that properties leading that rebound among Chinese stocks. David Inglis, thank you so much for that. Let's get to the broader markets. And of course, we're kicking off with a lot of nerves, the Fed, tech, and of course, the yen breaching 160. Avril Hong is on top of all those stories. Avril.
Absolutely, Has. I mean, all those factors at play for Asia-Pacific markets. David was just talking about their run-up in Chinese equities, and among some of the reasons for why we're seeing that sentiment shifting for the Chinese markets is what we're hearing from that Fed higher for longer narrative, and perhaps shifting investors' attention towards these cheap Chinese stocks. And the Fed, of course, meets this week, and we're expecting Jerome Powell to perhaps start sharpening that hawkish rhetoric, especially after a string of inflation upside surprises. That being said, we did get some data out on Friday which showed us how the PCE numbers for the monthly data is actually helping to ease some of those concerns. But let's take a look at what we're seeing on dollar yen, because that, as you say, Has, is really what's captured investors' attention. Part of this, of course, is after the dovish hold from the BOJ last week, and then also Ueda in his presser not quite signaling concern related to the yen weakness. So it popped up above the 160 level against the greenback. Perhaps not quite surprising given how Japan is on break today and there's thinner liquidity. So these big price movements were not entirely unexpected. But let's take a closer look as well, because there are a number of superlatives that the yen has hit against its peers, whether you're looking at the dollar, the Chinese yuan even. And this is a time where we're looking towards potentially that BOJ intervention. Remember, it's also about the pace of that depreciation, which seemingly is picking up, raising questions as well about the credibility of Japanese officials.
That's right. The yen down 2% just last week alone. That is rapid, if you ask me. Let's get perspective from Claudio Piron, co-head of Asia FX and Rate Strategy at Bank of America Securities. Good to have you with us. Okay, so some say this yen breaching 160 has to do with algo's fat finger, but maybe it's just a case of traders wanting to push and see how far it can go lower.
Yeah, absolutely. I mean, it's just a function of fundamentals in a certain sense. The US data continues to be very strong, as you've just mentioned. The earnings, fantastic as well. So it's a difficult position that the BOJ finds themselves in, because if you intervene, really the most important thing is you have to be credible. And so that issue comes right against that issue in terms of the US data and the yield gap that is presented to themselves. So when you're faced with that, it's not just then a question of the credibility, it's then how to calibrate, particularly in thin liquidity. So I think any action that they will come in will be a smoother action. It won't be the heavy-fisted action that we saw in 2022, for example.
Kando has come out to say that it will intervene if it sees rapid movement.
Yeah.
What exactly? He says if you see a 10-yen move within a period of a month, we've seen 7 in a month, but 2% in a week, and 10% on the year. That's massive.
It is massive. One of the key thresholds and conditions we were looking for has been triggered now, and that has been to see 1 month implied volatility in dollar yen move above the 10% threshold. And that to us characterizes a nature where the market is starting to get dislocative. We saw a couple of weeks ago the trilateral statement from the Ministry of Finance in Japan, Korea, and the United States saying they're closely focused on orderly functioning of markets. And if we start to see more volatility come in through, let's say, in implied volatilities, or as well, what was noticeable last week was that the rest of Asia was relatively calm. Although then we saw Bank Indonesia do a surprise rate hike, which suggests, well, you know, people are starting to get more worried what it means for other currencies in the region. And I think that's the other threshold that we need to watch. Is the yen a problem for the rest of the Asia? Is it a problem for, as well, US Treasury markets and JGB markets as well?
It could be a problem for the yuan, right? I mean,
absolutely.
yuan bulls would want to see intervention in the yen.
Yes, absolutely. And if we don't, then maybe we start to get some incremental movement in dollar renminbi. And we've seen funding conditions ease up on dollar CNH, on the CNH market. That suggests that the tight grip of the PBOC is being a little bit more relaxed on that front. So that may say, well, we might be willing to concede to some movement. We've seen the dollar China fixing move above that, incrementally above that 7.10 level. So that may be a factor that they may be preparing for a little bit of adjustment on their side. Our quarter end forecast for dollar renminbi is 735, and then for Q3, Q4, 745.
The thing is, for Japan, there's reason to exercise restraint. In an environment of higher for longer, we don't even know what the Fed's going to do or not do this year. I mean, could it, I guess, put its credibility into question if it just doesn't do anything?
I think, again, it depends on the disorderly versus orderly kind of behavior of the market. Yes, you can examine this as being somewhat fundamentally explained. What's also important is that to say that a lot is priced into the market in terms of the Fed, in terms of the hawkishness of the Fed. We've only got about 33, 35 basis points of rate cuts priced in. So a lot of the kind of damage has been done in taking back those Fed easing calls. So, you know, again, as long as they can adjust this currency in an orderly manner, then I think we're okay. But it is important, particularly when we start seeing these 30-year levels being taken out in the market. It starts to have more meaningful consequences for everybody, and so they may have to come in to try to stabilize the situation.
Claudia, you got to imagine or question how much is needed to actually support the currency. I mean, given that you don't know how high the dollar might go, what is the level that is comfortable for both the BOJ and the Ministry of Finance? Is it below 150? Is that the level that is comfortable?
I think no. I think in a certain sense, if we were to get back to 150 level, that would be okay by the end of the year. I think that would be a comfortable level in some sense of what we're seeing. I mean, it's important as well to look at real exchange rates in the region. And if we look at real effective exchange rates in the region, for the renminbi is actually quite weak. It's at a 10-year low. If we look for Korea as well, as in a somewhat similar position. So it's important to look not just at the nominal value of exchange rates, but the real value of exchange rates. And we're still faced by the fact that actually, by that metric, the dollar is looking overvalued. The question for everybody is, when does that dollar cycle turn? And we keep extending that dollar and the US economy economic outlook out. So I think, you know, that has shifted to 2025, and that's where I think the ground has shifted to. So I think everybody is now conceded that the rest of the year, to some degree, will see this dollar strength continue.
How much capacity do central banks in this part of the world have to resist and wait for the Fed?
It's difficult. We're running on thinner ground. In particular, when you look for some of the smaller open economies, we've just mentioned Indonesia, but you've got the Philippines, you've got the Thailand as well, to a certain degree. I mean, Thailand still has ample FX reserves, but the point of the matter is, it's not just about the FX reserves. It's a fact about the state of the economies. They almost have the opposite situation to the United States. The United States has got great growth, sticky inflation, problematic inflation. Asia has got great inflation, no inflation, you'd be hard-pressed to find it. But they've got disappointing growth. And in fact, Asia needs rates lower, not higher. But in an attempt to create FX stability, and in the fact of Indonesia, they still need those inflows into the country. They've attempted to make an offer you can't refuse and raise the interest rate in that bid. But again, it lacks the credibility when you look at that there's no inflation, that the situation is in growth there. The market, coming back to that original proposition about having credibility, the market will say, well, how credible is it that you're trying to keep an exchange rate value against the dollar when your underlying economy requires weakness in the exchange rate, given the disappointing in growth and no inflation?
So given the scenario you've just painted, what would be the best trade? Some say the Indian rupee would be the best carry because there's a lack of vol. We have an RBI that is supporting currency, ensuring stability. What is the best trade?
Yeah. Well, in a way, you think about it, you've got your reflators, you've got your deflators. India's in the reflator camp. Growth is good. I think they have no issues on that front, and I think that's credible in their currency, and they've got the FX reserves to keep it where they want it. But again, coming to the deflationary side of things where inflation is lower, Thai baht. So short Thai baht to 38, even we could get to 39 levels. And I don't think, as long as it's orderly, there's much resistance to that, because Thailand's growth is a bit disappointing. We'll get export numbers this week, which show they're lagging behind. So from that perspective. Indonesia, again, you've got carry there, so it's a bit difficult to be short on that front, but it will lag behind. And peso as well, probably be one that will struggle as well in this kind of environment.
We have to look at euro dollar as well.
Yes.
I mean, that divergence in policy.
Yeah.
Are we looking at a weakening euro dollar as we head towards the end of the year?
Yeah, we do, but we're not in the parity camp. So we think, again, the important thing to balance things is a bit nuanced, but to see what's in the market, what's priced in the market. We'll get some inflation data as well, so we'll need to watch how that pans out. Maybe that delivers an earlier than expected ECB cut. We'll see. But yeah, there's a glide path for a lower euro as well on that front, but we think it's more gradual, and a lot has been priced in terms of the relative expectations of the
Okay, just one final question
Yes.
before I let you go. The Fed, of course,
Yes.
it is front and center still,
Yeah.
and data coming out of the U.S. as well. How is it all going to play out and shape the Fed's thinking?
Well, obviously, we've moved, like a lot of the street are, cut to December. I think it's very hard for Fed Chairman Powell to out-hawk the hawks in this market. So, I mean, he'd literally have to say something that they're entertaining the possibility of a rate hike, or they think that their current stance is not restrictive sufficiently enough. So I think those things are off the table for the moment. And again, he just has to be in this annoying kind of data watching mode for the market, which is frustrating, but it pushes things out further for longer.
All right. We have to leave it there for the moment. Claudio Piron, BofA Securities, well, still ahead this hour. Startups in India have seen funding dry up and valuations fall. We speak to a VC who's bullish on the country's emerging businesses, especially in the beauty and food sectors. Rukam Capital will be joining us later this hour. Keep it here with us. This is Bloomberg. Welcome back. Elon Musk is in China on an unannounced trip seeking approval for a driver assistance software that could help arrest Tesla's revenue decline. We heard from the Tesla CEO in Beijing.
It's good to see electric vehicles making progress in China. All cars will be electric in the future.
For more, let's bring in our Chief North Asia correspondent, Stephen Angle, in Beijing. And Steve, of course, the timing pretty interesting. He just delayed his trip to India. You gotta, feel like there's a sense of urgency to this trip.
Yeah, there is. I mean, he's postponed that trip to India that was supposed to happen last week, and that would have included a meeting with Narendra Modi. Obviously, there are other challenges in the Indian market to entry, especially some on the tax front. He also, of course, wants SpaceX's Starlink to go into the Indian market. But there are more pressing issues, obviously, after coming off the first year-over-year decline in quarterly revenue since 2020. Tesla is cutting headcount and looking to accelerate new models. But, of course, it comes at a time when the Beijing Auto Show is going on. I was there last week on Thursday, Friday, and excuse me, I hadn't caught up on the EV experience, if you will, and the developments in this market since the last time that they held the auto show here in 2020. 4 years was a long time, and the Chinese makers have definitely upped their game, and we saw that on display, whether it was BYD or even the tech players like Xiaomi, really offering tech-laden cars, EVs, where Tesla wasn't even at the auto show. They had no new models to offer. And look, they're early adopters here. They want tech at home. They want tech in their car. And so Tesla, I think, sees some urgency here. And you mentioned that software, that, autonomous driving software. It's not fully autonomous, but it's the FDS system. It's the full self-driving. It doesn't make it fully autonomous, but it's a linchpin. It's key to Tesla's revenue stream at a time when revenue is down. In the United States, they charge $8,000 for that system onto new Teslas, or a $99 a month subscription. And it's I would assume, applied to get approval in the Chinese market. However, there are lots of hurdles. There are lots of cameras involved in this system. There's data security, and there's safety concerns. So he obviously went to China. He knows Li Qiang, the premier. Li Qiang is the former Communist Party chief in Shanghai when he got approval for the Tesla plant, the most productive plant, by the way, for Tesla in the world, built outskirts of Shanghai. And Li Qiang, this man here, was the one who essentially approved that. So they have a relationship. So he flew in at 2 o'clock yesterday afternoon, quick trip, went to meet Li Qiang, met with some other people. We're hearing from sources, and I don't usually like to report rumors, but we're hearing from some sources that he might have already left. We're going to track his plane and see if that was a quick one-day trip to China. Look, I usually make very quick trips into places like this. Nothing like, Elon Musk. One day into China and back.
I suppose you can do that when you have your own jet. Steve, you talked about how Tesla wants to arrest its revenue decline, especially in places like China. The question is how?
Yeah, again, they need to offer better and more models right now, because what we saw at the auto show clearly showing BYD and the other players tapping into exactly what the local players want. And again, the legacy automakers are playing catch up as well, because the new buyers in China, they know what they want, and the Chinese makers are making what they want. Yes, there's a massive price war going on too, which is going to help obviously sell more cars, but it's going to hurt profitability. So there is going to be consolidation, but Tesla needs to offer more of mid-price perhaps car to compete with the top list of cars that are selling in China. I caught up with Bill Russo. He's from Automobility, longtime analyst, auto analyst in this market. And here's what he said about Tesla's problems in the China market.
Tesla launched the price war last year because they saw the signs of weakness already on the horizon in China. They're not even here at the auto show. They don't have new products to brag about that are relevant to the Chinese consumer. It's these companies, the disruptors like Xiaomi and Huawei inside of many different brands, that are really the ones to watch right now.
I talked earlier about some of those regulatory hurdles, obviously, for the FDS system. We did get a statement coming from the China Association of Auto Manufacturers that came out yesterday afternoon, coinciding, coincidence or not, with Elon Musk's arrival, essentially giving or saying that Tesla's Model 3 and also Model Y have passed data security reviews. And keep in mind, Tesla has kept its data of its Chinese customers' cars in China, onshore, as required by Chinese law since about 2021. So Tesla is doing the steps to remain compliant. They just need to get over that hurdle to get FDS, full self-driving system, approved in China.
Steve, thank you. Bloomberg Chief North Asia correspondent Stephen Angle on Elon Musk in China, where he says he's meeting old friends. Well, plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back, and we're keeping a close eye on China's stocks gaining momentum, reversal of fortunes. Confidence seems to be building. Take a look at where we are in terms of property stocks in particular, powering ahead, racing higher this Monday, helping to lift most onshore indexes. Investors buying into the narrative that real estate is finally ready to shake off the gloom. Of course, here we're talking about Evergrande gloom. China Vanke currently up by more than 18%. Sci-Fi Holdings higher by 20%. The Hang Seng Index getting a lift on the back of that, up by 1.5%. Of course, it had the best week for the year. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. China markets just heading to lunch, and The mood there is pretty bullish. Take a look where we are into the CSI 300 index, up about 1.5%. Bear in mind that industrial profits announced over the weekend actually pointed to sluggishness, but not enough to dampen that spirit that we're seeing today. Property in particular lifting that rally today. We have China Shanghai Comp up by 0.8%, and the yuan at 724.62, pretty much unchanged versus the USD. Let's take a closer look at Hong Kong equities. And Avril Hong is on top of that. And what a run for the Hang Seng Index as well, Avril.
Absolutely. If you take a look at the way it's come up 20% from those recent lows, but when you highlight how it is a bullish mood, I think that speaks to how there was a low base. So perhaps hesitate to call it a bull market. Still, it is a recovery nonetheless. And let's take a look at some of the factors that are underpinning this, because we have seen analysts call the bottom on Chinese equities before. They have been proven wrong, but this time around, that run-up seems to be fueled by following that GDP upside surprise from China for the first quarter, and then subsequently analysts really upgrading their forecast full year for the Chinese economy. But also, I think this is all speaking to what we see on how cheap Chinese stocks have become. They've also been seen as a bit of an alternative compared to what we're seeing out of US growth stocks, especially given the Fed's higher for longer narrative. Now, to your point about we're seeing on the property sector, these are some of the counters that we've seen run up today, and this is also against the backdrop of how the Chinese developers index, the Bloomberg gauge of it, the ones listed in Hong Kong, they've been seeing a massive surge, and this is not something you typically see on this gauge, Has.
Well, the Fed also in focus, Avril, a recalibration and perhaps impact in Asian currencies.
Yeah, I think that worry really coming through about whether it was going to be 6-1 and then now perhaps no cuts at all from the Federal Reserve. And that seems to be fueling what we see on the dollar resilience. This week, we could really see the central bank kind of sharpen its hawkish rhetoric. And that is also what's at play when we take a look at dollar yen, especially after the BOJ's dovish hold last week. So dollar yen, perhaps unsurprising given how Japan markets are shut today, and we're seeing thinner liquidity, those big spikes above 160, previously moving back a bit lower now, but we are seeing that volatility raising those concerns about whether we're going to see Japanese officials step in. Let's flip the board and take a look at what we're seeing, because it's not just how it's weakened against the greenback, the Japanese currency. It is also against the yuan, record low against the euro, and for some of these EMFX, they might also be waiting out for yen intervention. Just think about how it's trading versus the renminbi, and this is the weakest level since 1990. Back then, it was a very different looking Chinese economy, and how its relationship has fared since then with this Japanese market. That is also all in play here, Haas.
That's right. Where is the red line? When and where will we see intervention? Avril Hong, thank you. Let's dig deeper into markets, bring in MLive strategist Mark Cranfield. Let's start with China. What a turnaround. I mean, Hong Kong stocks have had a massive run-up. I mean, we're talking a bull market, world-beating. What is the story? What has changed?
Well, interestingly, this is a sentiment shift. And there's a couple of things which have come together in the past few days which are helping to fuel it, because it's not really about the data. Just over the weekend, the China industrial profits were quite disappointing, showing that there's still sluggishness in the Chinese economy. But we can certainly point the fingers in two specific directions. Elon Musk, thank you very much for visiting China. He's done a huge job to lift sentiment there. And the analyst reports we saw at the end of last week saying that the property market is about to turn. So the people that have been very negative on things like Evergrande, and correctly so for a long time, finally saying it's time to turn and look at property seriously. And there's been a couple of small incidents as well where some of the legal cases going on in Hong Kong, they've been given more time for the property companies to come together with a plan. So that's also a positive as well. But really, it's a massive shift in sentiment. People probably finally buying into the idea Chinese stocks have been undervalued for a long time, and now let's start putting money to work.
What path will this rally take? Will it be straight line up? Will it be volatile? Is there a sense how this will play out?
It's difficult to imagine a straight line because in the background, you've still got the uncertainty over the currency. the central bank in China has been keeping the yuan, in a way, artificially strong against the US dollar. And as Avril was just saying, dollar yen is going through the roof. Now, that is not good for the Chinese currency because the trading partnership between the two countries is so big. China can't really afford to allow its currency to be too strong against the Japanese yen, which it's been doing. So now it's buying time for itself. Can it afford to wait a little bit longer, hoping that the Japanese authorities come in and do it a favor, or do they sit back? That in the background for investors is a big question mark, because if you start throwing money into the Chinese market and there's a risk that the currency doesn't do what you want, you're going to start to lose money on that side as well.
And for the yen, people were talking about 160 being the next level. We've breached 160. Still, the Ministry of Finance is missing in action. When? What will it take?
Well, it looks as though we could be at a point where sometimes all it needs is for traders to see a really significant number. 160, maybe that's what it is. If you think of where the yen has traveled, dollar yen especially, where it's traveled this year, some traders are sitting on some pretty healthy profits here. And they might, even without the Japanese authorities getting involved, they may just say to themselves, this move is so big. We've reached 160 much quicker than we could have expected. You might actually see them start taking some money off the table just on the basis of that alone. It might not even need something. But we do have an FOMC meeting this week. And if Jerome Powell is a bit more hawkish than is expected, could see dollar yen go even higher on the back of that as well. From the Japanese authorities' point of view, I'm sure they'd like to see what Jerome Powell has to say before they commit themselves. In the meantime, the traders themselves may decide that, okay, this is enough, and we start to put a little bit of money into the yen from here.
The thing is, how long can it resist?
Very difficult, because it's a very one-sided situation at the moment. You look at the Japanese side, there's no great incentive apart from the Japanese equity market doing well.
The movements, though, have been pretty rapid. If it's 2% in just 1 week, isn't that a sign to worry?
Well, now we're starting to get into the realm of credibility issues, because from all the things the Japanese authorities have been saying, particularly Mr. Kanda, who's the man mostly responsible for the yen, he did say in February that when the yen moves by 10 big figures, I'm very concerned. It's done more than that. And it's also, the 2% move last week was a very big move in the context of dollar when it was already pretty high anyway. So it's broken all the thresholds of their sort of tolerance levels, and they still haven't moved. So really, in a way, something needs to happen. Either the market does it for them or they do, because otherwise people just won't believe that there's any bite at all from what the Japanese authorities say.
How are traders looking at the FX market right now? There's so much uncertainty in terms of how high the dollar can go, how low the yen can go, and what happens to the yuan.
FX traders are having a great time. There's volatility. Intraday volatility is lovely. Foreign exchange traders, there's nothing they like more than coming in and being able to see good swings during the day, because that gives them something to go after. What they really don't want is quiet markets where there's no chance of doing option trades, looking at cross rates. For the moment, FX traders are in heaven, and they would like it to continue as long as possible. But of course, the authorities may have a different view of that.
In terms of the best trade out there for the year, what are you hearing?
In terms of foreign exchange markets?
FX.
Yeah, I think if you look at the emerging market space, there's some currencies here which have been beaten up unfairly, really. They've just been following the Japanese yen. So you can look across some of the Asian currencies, look at some of the Latin American countries. They probably could rebound quite heavily if the yen stabilizes.
All right, if you're intending to go to those places, you may want to buy those currencies right now. Analyst strategist Mark Cranfield, we thank you so much for your insights. Still to come, we speak to a VC who's bullish on Indian startups, even as funding and valuations look challenged. Rukam Capital's founder and managing partner joins us next. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching India Focus. India starts trading in just under 4 minutes. We have futures pointing to a high open, pretty much in line with the rest of the region. Sensex index up 0.3%. The other benchmarks also in positive territory. We're keeping a watch on stocks like Maruti Suzuki. This is India's largest car maker. It reported better than expected quarterly profit as SUVs drove an increase in sales. It's been one of the best performers. Keep a watch on that stock in particular. Again, India looking to join pretty much the gains in the rest of the region. Let's stay with India. Prime Minister Narendra Modi has long been vocal about wanting to transform India into a developed country by 2047. But analysts at Oxford Economics say he still has a long way to go before achieving that goal, which would require a six-fold increase in the country's GDP. For more, let's bring in our South Asia economy editor, Ruchi Bhatia, in New Delhi. Ruchi, take us through what is needed exactly for India to get there.
Hi, Haslinda. Good morning. It's great to be on the show with you. The term Viksit Bharat, or developed country goal the Prime Minister has set for India to reach by 2047 is a task that has really come to define Prime Minister Narendra Modi's economic vision for his third term. It all started from the ramparts of Red Fort on August 2022, where he first spoke about the goal, and now it has become a part of the policy lexicon, being seen pretty much everywhere, from official speeches to government presentations, and even the central bank staff members have put out a report for that. Having said that, reaching that task is not going to be, or reaching that goal is not going to be easy. We have reached out to various economists, and what we do learn from Oxford Economics is that it would require the country's GDP to grow sixfold from the current levels of $3.75 trillion to almost $23 trillion. That would mean India will have to increase its per capita from about a range of $2,400 to about $13,845, which means, and this is, remember, the benchmark or the threshold that the World Bank has set. It means that the country will have to consistently grow at a pace of 8% for the next 24 years. That kind of a pace has been maintained by a country like China, and even still, it is not a developed country. And for India to be able to reach an 8% level on a consistent basis for the next 24 years is going to be a tall order.
Ruchi, it is about metrics. It's not just about per capita income. What are the other metrics that can be used to assess whether or not a country is developed? And when you use those metrics, where does India lie?
So there's no one particular definition that a country can use to reach a developed country status. There are different metrics being provided by the World Bank and different by the United Nations Human Development Index as well. But besides economic prosperity, one also looks at the education levels, the healthcare levels, and there is where we do see that there is a long way for India to reach the level that has been set up by the United Nations as well. In fact, India currently ranks on a medium level on the UN HDI index at about 0.644, and for it to reach 0.8, which is the level for developed countries, there's going to be a long way to go. In fact, we have spoken to various economists and analysts. The former central bank governor, Raghuram Rajan, has also been talking about that India needs to work on some of these metrics to be able to achieve that goal of a developed country by 2047.
All right, Ruchi, thank you so much for that. Our South Asia economy editor, Ruchi Bhatia, in New Delhi. Let's stay with India. It has the third largest startup ecosystems in the world, with a major focus on AI and emerging technologies. Our next guest runs an early-stage consumer-focused VC fund and invests in consumer products and services companies. Let's bring in Archana Jahagarda, founder and managing partner at Rukam Capital. Archana, good to have you with us. We know that when you take a look at, venture funds in India, they've pretty much slowed over the past few years. Do you see a reversal?
I think India and all the VCs in India, we are very, very optimistic about the entire startup ecosystem. I think, there's a lot happening just under the surface, which is not always visible if you're not an Indophile and you're not coming to India frequently. But all of us who are investing and looking at what's happening in India, I can tell you there's a lot of action, a lot of activity. And I think the spring is here from an investment perspective.
Talk to us about the action you're talking about. Which sectors in particular are attracting investments?
So, unlike the US, where I think AI, Gen AI is really all the, flavor of the season and all investment is going towards Gen AI, I think India is much more broad-based when it comes to investments. So when I look at technology, of course, Gen AI has got a lot of interest from all the VCs, both early stage and later stage VCs. We are also looking at a lot of deep tech companies. I think there is now a lot of respect and hope that deep sciences and research-based companies will give us a alpha return. On the consumer side as well, we are seeing that because India is underserved and we have such a large cohesive market, unlike a lot of other regions. So I think in pretty much all of the sectors, you can expect to do well, whether it's FMCG, beauty. On the consumer side, I think single specialty health care clinics are also an area of focus for all of us consumer VCs.
Archana, put some numbers to what you're saying. When it comes to VCs, what kind of investments, how much investments do you think VCs will put in India in the next 2 to 3 years?
I think, there are about 1,500 India, focused sort of VCs working in India right now. And I think we've got enough dry powder, maybe upward of a couple of $1 billion for sure, that is available in the early stage ecosystem. Bulk of it on the tech side will, of course, go to Gen AI and deep tech. On the consumer side, beauty is a very, very, and it shows the interest in beauty tells you a lot about how the Indian consumer is sort of more aspirational now. So it's not just value for money or the cheapest product that works in India now. I think there's a premiumization. McKinsey talked about it in their report that there's premiumization of products and services where the consumer is willing to pay a lot more. So I think we've got a lot of dry powder here in India for India-focused companies.
You talked about how you are optimistic when it comes to this space, but returns on investments is pretty challenging. How are you looking at that?
This is said a lot, but, and especially overseas, I hear this a lot. But when we, again, look at the domestic market, I mean, we are a 5-year-old fund. We've already done 2 cash exits, which is pretty darn decent. And I know that my other peers in the ecosystem are also returning capital as we speak. We've got the big ticket sort of return when companies have gone to IPO. Zomato went and has done a very, very successful IPO. Swiggy, its competitor in the food tech space, food delivery space, is also headed to an IPO. So there is a whole raft of IPOs that are both scheduled and have happened. Mamaearth went to IPO. I mean, I think it's a 2016 founded company. For the skincare company for a consumer company to go to IPO in such a short period is pretty impressive. So both on the consumer product side, platform plays, tech plays, I think India is seeing those exits. So maybe there's a new lens through which to look at, the exit and making money profile from India.
Archana, if it's so attractive, are you seeing overseas investors coming to India, perhaps investors from Silicon Valley?
So, I was in Singapore recently, in fact, earlier this month, and I was talking to some potential LPs there. And India definitely is the flavor of the season. I was in the US, earlier in the year. And again, like India is really hot. I think the sort of point I keep listening to or hearing is, we need to understand India better. And I'm like, you guys understood China, and there's a language barrier there, whereas we speak very good English. There's talent. We're a democracy. We've got a very, very highly educated sort of workforce available. So really, it's a function of turning focus and spending a little bit of time to understand what is happening over here. Is what I would tell investors. But yes, I think
Archana,
there is more interest.
Archana, thank you. Archana Jahagarda, founder and managing partner at Rukam Capital. Let's do a check on Indian markets. Been trading about 5 minutes now. We're seeing gains pretty much across the benchmarks in India, joining in the rally that we're seeing in Asia. In particular, of course, we've seen that strong rally in China's stocks in particular. Sensex index extending its lead by 0.4% right now, and the Indian rupee trading at 83.43. We're keeping an eye on Stocks like ICICI Bank and reported profits that surpass analyst expectations. Demand for retail loans continues to be strong in the world's most populous nation. We're seeing ICICI Bank up by 1%. Maruti Suzuki also beating estimates, now up by about 1%. Now, still to come, Pakistan's central bank widely expected to hold rates at today's meeting, but Bloomberg Economics sees a 100 basis point cut. We'll have more on the state of that economy next. Keep it here with us. This is Bloomberg. Pakistan's central bank is widely expected to stand pat on rates this Monday, but Bloomberg Economics believes it could kick off an easing cycle by cutting its key rate 100 basis points. For more, let's bring in our Pakistan Bureau Chief, Fasih Mangi, in Karachi. Fasih, I mean, we have inflation still lingering in Pakistan. That is a key consideration.
Yes, absolutely. Interest rates are at a record high since last summer, 22% to be precise. What's happened recently is that inflation is still high, the highest in Asia, but we've seen it come down in the past few months. And right now, inflation has dropped below interest rates for the first time in 3 years. So some economists, including Bloomberg Economics, now expect interest rate cut cycle to start from today. Later today when the central bank meets, but in a Bloomberg survey, we've seen that the number of people who expect it to remain unchanged is higher than those expecting a cut.
Fasih, it is also about the IMF program. A decision is expected later today. What are we expecting?
So that's a very key decision as well. So what we've seen in the past month is that more people have gone from a cut to a hold decision. And one of the reasons is the IMF, because analysts say that the IMF likes to keep rates more tight, and Pakistan won't make a decision that would possibly, impact their negotiations. There are two programs that are being discussed right now. The IMF Executive Board is expected to approve the release of a $1.1 billion loan tranche later today. And then there is another new program, discussions going on. The Prime Minister Shehbaz Sharif even met the IMF MD in Riyadh yesterday, and discussions for a new, longer, bigger, long-term program. So Pakistan won't do anything to hurt a new loan program. Yep.
Fasih, thank you so much for that. Our Pakistan Bureau Chief, Fasih Mangi, in Karachi. Let's take you back to markets where we're seeing a surge in terms of the gains in Hong Kong as well as China. We know that property stocks in particular driving that. Tech also, take a look where we are in terms of the Hang Seng, up by 1.3%, taking its gains to 20%. It is headed towards a bull market. HSTech driving it as well. And we're also keeping an eye on those property plays, powering those broader gains, helping to lift most onshore indexes, investors buying into the narrative that real estate is finally ready to shake off the gloom. In terms of the yen, breaching 160, currently 159.35, waiting for intervention. That is it. From Bloomberg Markets Asia, this is Bloomberg.